These are 5 stocks that we're going to analyze that have been requested by our Everything Money community. These are very popular stocks. Micron, Palantir, Snap, as in Snapchat, VALE, and Netflix. Now, we're going to run through our 8 pillars on every single one of these stocks. We're going to run through the stock analyzer tool in all 5 of these stocks because every investment is the present value of all future cash flow. So we're going to make assumptions about the future, and the stock analyzer tool will tell us what price to pay for the stock today based on those assumptions. So if you're new to this channel, I'm Paul, that's Mo. I've been teaching value investing for over 10 years and the last 3 years on YouTube. Now, having a YouTube channel does not in and of itself make me an expert, but I guarantee you that if you watch this video and 4 others, you'll walk away with a better understanding of money and investing, and you'll walk away probably saying, hey, I might not agree with everything Paul says, but he has a process and he has a way of thinking that makes sense logically. So let's dig right into it. We're going to use our software, start with Micron, going right to the 8 pillars tab. So a lot of X's here, but the things we like are valuations are lower. The 5-year PE is 7.38. The 5-year price of free cash flow is 14.7. Not much in terms of shares outstanding increase. Low debt, only 2.3 years of their last 5 years of free cash flow will pay off all their long-term debt. But we've seen a revenue increase, but with a lower net income and a lower cash flow growth. So those are things to understand here when you do more research on the company. But let's go right into the analyst estimates. They are seeing, some whipsaw in terms of earnings. So a drop and then grow back up again makes sense. And in terms of revenue, oh boy, all across the board, basically even for the next 5 years. So we're going to use this data in our stock analyzer tool to make our assumptions. So revenue growth. I'm going to go with 3% on the high side, 0 in the middle, and -3 on the low side. These are very conservative assumptions, but like I said, the analysts aren't expecting a lot of revenue growth and profit growth in this company. Profit margin. I'm going to go back to a more stable time of the last 10 years. I'm going to go 20, 22, and 24. Free cash flow, I'm going to go with 10, 11, and 12. PE. Now for PE, 5.7 is too low, but for a company that's losing revenue growth, I'm going to go with, actually, you know what? I'm going to go revise my revenue growth numbers because that was for 5 years, but the next 10 years of the chip sector should be growing 12% a year. So I'm going to go 0, 3, and 6%. PE, I'm going to go with 10, 12.5, and 15. Same with price of free cash flow. And for my desired annual return, I can get 9 or 10% from investing in a long-term ETF. So in order to invest in an individual company, I need to get something better than that for margin of safety. So I'm going to do 12.5 because I've made low assumptions here. And as my assumptions get higher, I want a higher return because I'm making higher assumptions. So I want to drive that stock price down because it's less likely those assumptions hit. Hit the analyze button. Stock's currently at $51. And look at this. Low side of 25 to 50, high side of 40 to 78. So if you like this company based on earnings, I would be doing more research, add it to your watch list, and go from there. Next company, Palantir. Mo, take it away.
So guys, for Palantir, this is a $16 billion company that is not making money yet. Now, they do have free cash flow, which I like. And something else that I really like about this company, they have a return on invested capital of 10%. So that tells me that management is doing a good job because I like to see that return on invested capital over 9%. Profit is not there, obviously, and that gross margin we have to pay attention to. That's 79%. We're going to have to look at that. And when we make these estimates into Stock Analyzer tool, I'll factor that in. No dividend being paid, which is not surprising. I'm going to come over here to the analyst estimates. There's a lot of potential here that we're seeing. I mean, look at the earnings per share growth over the next 5 years. And when I do Stock Analyzer, I'm going to do a 5-year analysis on it. And year over year growth, I mean, it's consistently sitting in that 22 to 25% range, even going out 5 years. So there is potential with this company. The question is, I might need your help with profit margin on this one.
Okay.
Because I'm not sure where to go with this. Let's put it into Stock Analyzer. So on the high side, I'm going to go 5 years here just because there's a lot of unknowns. It's a new company. I'm going to go with 25%. That's what the analysts are saying. Let's go with 12% on the low end and 18% in the middle.
Okay.
What do you think about that? That profit margin, that gross margin is 79% right now.
Yeah. And they're a software business.
So it's high. I was thinking 20, 30, 40.
I think it's reasonable.
Okay. 20, 30, 40 was my initial thought.
Now remember one thing. That assumes the stock analyzer tool assumes they hit that profit margin today and start generating profit from there. That's not necessarily the case. Right. So we have to factor that into our desired return.
Right. Now, free cash flow margin. I'm going to sit at the same. Now they are generating free cash flow. I'll sit at the same numbers.
I agree with that.
Yeah.
Because free cash flow and earnings should be the same over long periods of time.
Correct. PE. Is 14, 16, and 18 too low for those?
I think so. Numbers? Because this one still has a lot of growth potential, even in 5 years.
18, 20, and 22.
So what Mo's doing there is, even though the average PE in the stock market is 15 or 16, he's going higher because at the end of 5 years, there's still a lot of growth potential left for Palantir. And you should pay a higher multiple for companies with a lot of growth potential.
Now, for the desired annual return, there's a lot of speculation going on here. I think I'm going to go with 18, 21, and 24%.
I think that's right.
Yeah. Now let's see what we spit out. Doesn't mean go buy it today, guys. Let's see what we have here. So we're sitting, and from multiple of earnings perspective, $3 to about $9.50. And the same thing for the discounted free cash flow model because I put in the same assumption. So to me, this is a company, if you even like these numbers, you need to go do more research, understand what's happening. They do a lot with the government. Go understand those contracts.
It's so funny. I think we've done this company like 10 times, and every single time it ends up being around $5 or $6 a share. And when it was at 40, people were like, you guys are so dumb to think it's going to be at $5 or $6 a share.
Guys, it's $7.81.
Awkward. All right, let's do Snapchat now. All right, so Snapchat. Okay, the 8 pillars for Snapchat.
Snap face, in the words of
Snap face.
Bill Belichick.
Bill Belichick. No earnings, no free cash flow, tons of shares outstanding, increasing the shares outstanding, revenue growth, net income growth, free cash flow growth. So that's good, but they don't have free cash for the last 5 years. Analyst estimates, they're expecting profit to go from break even this year to $3 a share in the next 5 years. And they're expecting about doubling the revenue growth over the next 5 years. So stock analyzer tool, I'm going to do the same thing as Mo. I'm going to go to 5 years here. Revenue growth. What was that revenue growth? The percentages. Let me go back here. That was high teens. So I'm going to go 8, 14, and 20. Profit margin. Oh boy. They don't make profit. They hate profit. So I'm going to go with 10, 20, and 30. 10, 20, and 30 on free cash flow. PE, I don't like the company versus other. So unless they, if they're able to do this 20% revenue growth, my guess is they've changed their process and gained some traction. So I'm going to do 13, 16, and 19 on PE and price of free cash flow. But for my desired annual return, guys, I'm going way higher here because I think Snapchat is the worst of the social media companies. So I'm going to go 20, 25, and 30% returns. I really want a big margin of safety here. Hit the analyze key, boom. Low price 3, high price 14, middle price 7. I'm probably not even touching this thing I might probably even do my research on it until it hits $8 a share. So that's my take there. Next one, VALE.
Guys, VALE. It's an 8-pillar stock. A lot of people really like it. Everything they're doing seems to be correct right here. But what does this run in line with? It's iron ore. And the biggest thing to look at, I'm going to pull up right here. This is the long-term chart for iron ore. This is a 5-year chart. And I want to point out a couple of things. Here in June of 2021, look where we are. We're at this peak. And then look at November of 2021. That's our peak to trough. Now watch this. I'm going to come over here to an iron ore chart. Here was that peak, June of 21. Here was that trough, November of 21. So here's the thing that I'm trying to say. You need to pay attention to iron ore prices. This is a lot more than going through just this company, looking at the numbers and saying, yeah, this is going to hit on all cylinders just because it's 8 pillars. You need to truly understand and say, this is going to run with the commodity of iron ore. So let's see what the analysts have to say, because commodities are a very difficult space to be. Negative. But I mean, who knows? I mean, earnings per share, commodities, as we've seen over the past year, have been absolutely out of control. This thing was the greatest thing, and then it was the worst thing. There is a lot of negative growth going in there through the next 5 years.
Now, there aren't many analysts following it.
There's not. It's very small. So if I'm you and you're really interested, go and find more than 10 analysts. There's a lot more people that write about this and do research on this. So let's throw this in Stock Analyzer. Revenue growth, I'm going to put in 5 years just because not only is it hard for me to do because it's commodity, but it's hard for me to do because commodities are all over the place in general. So let's put in that negative growth. I mean, I usually go on my high side for analyst estimates of what they're saying, and they're saying negative 5% in 5 years. So I'm going to give them the benefit of the doubt and go with 0. And mid, I will go -2. And the low, I'll go with -5. And we'll see what happens from there. profit margin. Over the last decade, it's been about 11%. Let's go with 9, 10, and 11. See if they can stay in that range. Because remember,
can I recommend something there?
Sure.
I'd recommend 8, 12, and 16 because even in the last 5 years, they've had 22%. So,
and that's a good point because even they have had 22%. And what I should have done is say, yeah, this thing, even though it's all over the place, there's still those times of really great profit margin. So 8, did you say 8, 10, and 12?
8, 12, and 16.
16. Free cash flow margin, I'm going to put in the same numbers, 12 and 16. PE, I'm going to put in, 10, 12, and 14. Same thing for the price to free cash flow. And my desired annual return, because it's a commodity, I'm going to go 15, 20, and 25, especially based on what those analysts are saying. Let's see. So current price is $13.32. It's anywhere from the range of $5.50 to about $11.75. So maybe this is the time that you start doing a little bit of research on it and understanding the commodity and that space in general.
My guess is you'll probably do pretty well with VALE if you buy the stock when iron ore is at lower levels than history. Now, remember, we're going to our last stock, Netflix. And you might look at our numbers going, man, these guys are... Remember, stocks are very, very high based on all historical levels. So it's understood, it makes sense. And we're also looking at some pretty hype stocks here that it makes sense that some of these are having issues. Yep. So finally, Netflix. Okay.
This one lately.
All right. 8 pillars on Netflix. Now, Netflix has fallen a lot lately due to their lack of user growth. No free cash flow in the last 5 years overall. 38 PE, increasing their shares, big revenue growth, big cash flow growth, and big net income growth. But because of no free cash flow, they have negative 2%. Now, the no free cash flow doesn't bother me as much. They might be spending a lot of money within their business. And that's something I'm going to look at really quick. Capital expenditures are very large. But also, they just recently got into cash from operations being positive. Okay, so let's look at analyst estimates. Going to increase their profit by about 70% in the next 5 years and increase their revenue by high single digits, mid to high single digits over the next 5 years. So not major growth because they already have 220 million homes. Stock analyzer tool, 5-year analysis. Okay, so let's go with 3, 6, and 9%. Let's say they're able to turn around that revenue growth big time. Profit margin, let's go with 10, 13, and 16. I'm going to do the same thing for free cash flow because over long periods of time, free cash flow and earnings should be very similar. And then for PE, I'm going to go with 12, 15, and 18. 12, 14, and 16. And same thing with price to free cash flow.
I like
now, finally, our desired annual return, I'm going to do 12.5, 15, and 17.5. Now, remember, Netflix was as low as like 170 recently. Wasn't it as low as like 170? Now it's 243.
It was. Yep.
182 was its low.
Yep.
Hit the analyze button. We have a low price of 80, a high price of 166, and a middle price of 120. So we ran right through these numbers very, very quickly. So you need to watch the next video on our 8-pillar process so you can understand more in depth about what those 8 pillars mean. Thank you very much for your time.